All right, yeah, we're recording. So, on Friday, we went over the fact that if you look at your trades, you're trading uh, results. On one side, you have your winners, one side, you have your losers. And if you were to separate your top 20% winners, in other words, if you looked at your best wins and ranked them from first to last, whatever the top 20 percentile is of your results, that's your top 20% of winners. So just to make sure this idea is clear, let me just show you what I mean. Give me 1 second. I need to pull up I have to pull up something to show you this. So strategy analysis. There we go. Hold on for 1 second. Okay, yeah, here we go. Okay, so here's a strategy. Don't worry about what it is. Just follow the idea here. So here I have a strategy, and we're just going to look at this part right here, which is the results. Okay, so this is for CHTR, the stock, and this is for Capital One, the stock. Again, doesn't matter which stock we choose. The key here is just to understand the principle. So for this particular stock, the best results right here, thanks, Jack, 1,284. Okay, the worst result is right there, which is negative 1,100. Sorry, negative $1,011. Okay, so you have your best result and you have your worst result. Now, if I were to calculate the top 20 percentile of losses, I need to know how many losses I have first. So let's go from here. So I have one there. And if I scroll down to the bottom, these are my worst losses, and I have 174 losses. Okay, that's what it says here, 174. So let's do a little math. 174 divided by 5 is going to give me the brackets, the number of results that would be equal to a 20 percentile. So you have your top 20 percentile, your next one, your next one, your next one. Basically, I'm just dividing this by 5 to estimate what that is. So it says roughly 34, it says 34.8. Now, of course, I can't divide 174 evenly by 5. So what I'm going to do is round up. So the first 35 count of losses, starting from the worst loss and going backwards to the smaller loss, that's going to be my top 20 percentile. So I'm going to count 35 results to get that. So let's do that now. So start here, that's number 1. Count 7. If you look at the bottom right, you can see the count number. So I'm going to count up to 35. That's 32. That's 35. Right there. So this range here represents the top 35, or the top 20% as far as ranking of losses, not the top 20% as far as size, but in this case, the top 20% as far as ranking. You could also do it by size. That works too, but let's just do this. All right, so when I look at this, what does this tell me? This tells me the order of my losses. Now, remember when we did the experiment on Friday, we found out by trying it ourselves. I asked each one of you, what was your best performing trade and what was your worst performing trade of the day? And you guys gave me your results. And I asked you the next question. I said, so of those results, For the trades that did the best for you, did the market have to go a substantial distance against you first? Did it have to take a long time? Or did you see the results, the positive results, almost immediately? And almost every one of you said, yes, the results that were positive came very fast. When I got into the trade, very quickly the market went in my favor. It barely went against me, and it just went right away in my favor. Or if it didn't go right away, very quickly after. Then I asked the next question for the losses. Your worst losses, how fast, how quickly did the market go against you? Most of you said very quickly as well. But some of you also said, well, it actually some of them took longer. They didn't happen right away. There was a large waiting period relative to the length of your typical trade where you are waiting and waiting and waiting, and then the market starts to go against you. So what we confirmed on that experiment, based upon a cross section of all the things you guys have been doing, is that the trades that go your way, that really, really work out well, the best winners usually go almost instantly in your favor. They don't hesitate, they don't spend a lot of time. They shortly after you get in start going in your favor without giving you too much hassle. The ones that don't, the worst losers that is, typically lose and go against you sharply, quickly, right away, or they take a longer time to do it, but they don't really go in your favor much at all. They almost always consistently go against you either right away, or they go a little bit in your favor and then they gradually keep going against you. And that's a very important realization because it means that there is an actual pattern that occurs when you lose and when you win that you can recognize. And since I showed you that it happened across different people, it wasn't just one of you, everyone who answered came up with a similar answer right on the fly. If you look at your trades today, if any of you had any really good winners, not like an average winner, but a really good winner, it probably went your way right away. And if you had a loser, your worst loser, that is, not your average loser, but your worst types, the ones that rack up the worst performance for you, they probably went against you almost immediately, or they never really went in your favor. They just kind of danced around for a bit, and then they start to go against you. There's a reason for that. The reason for that is that the market, when you time it right, when you get the timing nearly right, you don't have to guess at whether or not you did because the market just goes your way right away. And when you got it absolutely wrong, the market doesn't hesitate. It just goes against you quickly. And if you get it absolutely wrong, but the market doesn't go quickly against you, it just doesn't give you any indication that it's about to go your way. It just keeps flirting a little bit with gaining, and then it starts going down against you more, a little bit at a time, and then maybe you get trapped in that trade where you just can't accept that it's not going your way because it's going so slowly. Most of us are willing to bail out quickly when we see a trade go instantly against us with no hesitation. But when it's a slow, steady decline, there's a tendency for people to actually start to get hope. Every time the stock starts to pull back in the direction they want, you get hope, and then it turns around and keeps going in the same direction. Because the thing is, most of us, whether we admit it or not, have a hard time accepting when we see a stock consistently go the wrong way, and it's on a really great trend. And one of the things that we're defending our minds are trying to defend us against is something that we fear. We fear the embarrassment of knowing that we stayed in a trade that kept going against us consistently, and we didn't change our mind. What do you need an indicator for, Aaron? Think about the question. Why would I need an indicator to tell me that? You already see it for yourself. Your eyes tell you this. It's just a matter of whether or not you accept what you're seeing. Think about it like this, okay? Trying to think of a great example. Okay, let's suppose I'm using an example that's not quite align with trading, but it may help illustrate the point. So let's suppose that you're tasked with giving a presentation to a group of investors who want to invest into some business or some company you work for, whatever. So you go up and do your presentation and you stumble through it. You make all sorts of mistakes. The people look agitated. They look irritated. They're looking at you like, why is this person wasting our time? This is one, what is this person doing? Some people, when that happens, they'll pretend it's not happening. They think it's best to just keep going, to just act like they don't notice that these people are not following or not interested or are annoyed or agitated, and they just keep going. Other people realize if they keep going, then they're going to lose the battle anyway. So rather than keep going, why not just address the situation right then and there and say, hey, I apologize. I have my slides mixed up here. Let me just start over again if that's okay with you guys, or something like that. In other words, acknowledge the situation. Don't deny it. Ask for permission to continue and you go forward. And that's a standard business practice. When you start off on the wrong foot, don't deny it. Admit it. Acknowledge that you made a mistake. It wasn't intentional. Sorry about that. Let me just restart. Or better yet, if you know that you can't do the presentation up to par, you're going to have to reschedule because you don't want to give them a bad presentation. You want to give them a good one, right? And this is standard stuff. If any of you have done business before and you've had to do a presentation, you understand exactly what I mean. You don't just wing it. You don't just keep going. If you know that it's not working out, if you're not prepared correctly or whatever, you don't have to tell people that you weren't prepared. That might not be a good idea, but acknowledge the situation as it is. Okay. So if I were coaching people to do presentations, which I've done, and someone said, just to be clear, I'm just making a point about this. There you go. Right. So you don't need any special tools to tell you this stuff. You simply get into the trade, and if you're sitting there waiting and nothing's happening the way it's supposed to, you don't need anyone to tell you that it's not working out. You can see it right there. You know what's supposed to happen, and it's not happening. Just like if you're doing a presentation, you know how it's supposed to be going, and it's clearly not going that way at all. So if that's the case, then you have to deal with it right then and there. If it's not clear, you don't have any other choice but to keep going because you can't make assumptions, etc. You just ask a few questions maybe in your presentation. Hey, is everyone following me? Does this make sense? Any questions so far? Check your audience and you move on, right? But they still might tell you it makes sense and it's not making sense, right? You never know. But when you know you're really on the wrong foot, it's obvious you're on the wrong foot. You're talking, you have the wrong slides up. The persons are looking confused. They're like, wait, what are you saying? They're even asking you, like, I don't get what you're saying. What do you mean by this or that? You got to address that, right? So with trading, if I'm getting into a trade and it's not really going my way in the time frame that's supposed to, in other words, we're day trading, it's not supposed to take 2 hours for the trade to go my way. So if you're holding a trade for an hour, 2 hours, why? Unless it's going your way. What's the purpose of keeping money tied up in a trade that's not producing? Even if it doesn't lose, the money is tied in that trade. You need to move that money into something that's working, or better yet, just get it out altogether, because the longer you stay in that trade and it's not going your way, you're still exposed to the risk it could go the other way. And if you bet in one direction and it just won't go in that direction, it's just sitting there after it's been going in that direction before you got in, then chances are it's actually not going to keep going that way. It's going to go the other way. All I'm saying is when you look at your stats, you're going to notice that most of your losers, when you look at the time you're in them or the speed at which the market went against you, either you were in something very long and it just kept gradually going against you, or you were in something and immediately went against you. Now, if it immediately goes against you, there's nothing you can do about that. You don't know if it's going to do that until you get in. In other words, the issue is not that you lost a trade. Losing a trade is absolutely, unquestionably part of the game. There's no way to avoid losses. Let me just repeat that. You cannot avoid losses. You will have them. They're always going to be part of the game. You have to plan for them, you have to manage them, but you can't believe that they're not going to occur. They will occur. They have to come with the wins. So because we know that, we don't want to stick around with the losses too long. Meaning that if I'm sitting on a trade and it's taking half an hour, 40 minutes, an hour, and still not going my way, even if I'm not losing, I have to do something. Either reduce the size of the trade by getting rid of shares in the position, even if it's at a loss, or get out altogether if there really isn't any good reason to expect it's going to work out. Now that takes discipline, but mostly it takes observation, willing to look at what typically happens. This is why your stats on prop reports are so important, because they actually tell you how long you're holding a trade. So if I notice that, which is something I point out to a lot of people, a lot of the losses that I see in some people, they take forever to get out the loss, but the profits they get out within minutes, the losses they get out 30 minutes, 40 minutes, an hour later. Why? Because they're not accepting that, yeah, I got into the trade and it's not working out. It's not doing what it's supposed to do. Most of us are getting sucked into some some poor information that's out there about trading. You're going to go online, you're going to read books, and people are going to tell you to be patient, to wait for the trade to play itself out. You got to, give it room to work. And while those statements are not technically false, the meaning of those statements usually is not right. In other words, the people who are saying this, they probably don't know much about where those statements came from. They're just repeating something they heard that they know other people believe in. That's marketing 101. You just repeat stuff that you know people resonate with. If you're a beer advertiser, you talk about stuff that your customers will like, or if you're a car advertiser, you talk about the stuff your customers will like, right? It's not, but obviously, if you're going to be effective at it, you better understand what those things mean. But when it comes to online education about trading and videos, people will just say things like that, and we just take it for granted that, oh, that must be the way it is. Let your profit run, cut your losers short. But what does that actually mean? What's the actual real way to do that is my question. And that's where, I'll give you guys advice on how to do that. But in short, these results here that you're seeing that I highlighted represent the top 20 by rank of losses. And if I combine them, which I'm going to do right now, and find out what the total is, the sum total there is negative $13,595.14. Now, if I look at the top, I just want to show you this for a second. The overall results for this strategy, whatever strategy it was, I don't even remember what strategy it was, but the overall results were negative $6,188.53. That's a loss. But tell me this, if I shave off $13,595 in losses, what's going to happen to this number? If I get rid of those losses, what happens to that number right there? What does it do? Turns positive, right? It turns positive. Does everyone understand that? If you don't get this, let me know right now. If you're not clear about what I'm saying, let me know right now. If I cut off those bottom losses, what happens to my results? They go positive, right? Now, here's a couple things that I don't know. And I would have to do further research to find out. What I don't know is how far the market went against me or the strategy to generate these results. In other words, this $1,200 gain, I need to find out, did the market go 200 and whatever dollars against before it went that way. In other words, I have to look at the individual trade results to see if this drawdown of $235 was that required to make any of the gains that I see here, any of the profits I see here, no matter how small or how big. Did the market go $235 negative first before these were generated? And if it did, then any of those results have to be removed from the results. And you never know, maybe the top 5 or so might actually get, or 4 might get removed. You never know until you check. But here's one thing we just established on Friday. When we looked at our best trades, we universally saw that they usually went our way almost immediately. There was not much deviation. There was not much back and forth. It just went the right way, either right away or shortly after getting in. Not hours later, not an hour later, but minutes later at the most. It starts to go your way. All of you have seen this. All of you have noticed that that's the case. But when you stick in a trade for long periods of time and it's not working out, there's a reason it's not working out. You got in at the wrong time. In other words, if your timing is right, the trade should go your way fairly quickly. If your timing is wrong, you're parking money in a trade that's not going anywhere. Even if it eventually is going to go your way, you don't need to be in the trade during the period of time that you're waiting for it to finally start to move. You want to get into a trade when things are starting to move, not park yourself in it and wait and wait and wait and hope it goes somewhere. We're day trading here. This is not long-term investment. We're not buying land in Arizona and waiting for it to go up in price 10 years later. That's not what we're doing. We're day traders. As a day trader, I need to know things need to move quickly. Yes, Aaron, that's why I'm telling you. You don't need an indicator for this. It's not an indicator. It's not a study. It's an observation. The more you trade and the more you try to trade here. Obviously, if you're new at this, I get it. But the more you apply yourself, you're going to generate statistics. And those stats are going to actually tell you what you're doing well and what you're not. And as long as you focus on those stats and ignore nearly everything else, that's what's going to tell you how you have to perform in order to generate profitability first. Once you can be profitable, then you work on the actual effectiveness of your strategy. So in other words, being able to at least get some profits is first, even if they're not large. A lot of people underestimate the value of just learning to be profitable. Everyone's focused on, I got to make a lot of money. 90% of the people I've trained over time, I'm using a quote to say 90%, it's higher than that, but at least 90% of the people I've trained over time, and I've been doing this at this point for nearly 20 years, the one thing I can tell you without exception is that in the 10 plus years I've been training people, because I didn't start training people at the beginning, because how would I? You know, how are you going to train some people when you're just getting yourself established, right? You only start training when you've been doing it for a while. So it took me about 10 years before I felt comfortable training other people. But when you are training people, one of the things that I point out, or one of the things I notice about people, is everyone focused their attention on making a big return. Everyone. It's like, I need, what's the hot stock? What would you do right now to make, how can I make this much a month? Or all these questions, right? The first question should be, what do I need to do to be able to be profitable? Even if I'm not greatly profitable, I need to get to profitability first. That is the absolute requirement. No one gets any farther in this game until you learn how to be profitable, right? So if you learn how to be profitable, that's step number one. But how do you become profitable? You become profitable by cutting losses. Everyone focuses on this side of the equation. How do I get more trades that end up like that? That's the mistake. This is the actual mistake. When you focus on how to get bigger gains first, the mistake is you're not actually learning how to cut losses, which is more important. Cutting losses is what gets you to profitability. Once you can do that, then you figure out how to squeeze more gain out of the risk you're taking. In other words, you figure out how can I risk $200 and sometimes get a $1,200 gain? How can I risk $200 and sometimes get a $1,000 gain? Not every time, but sometimes. What can I do that will not violate my risk cutoff, but will give me the way to make more money? This is why in our program we set parameters of risk maximums. Now, I have to use this as an example, not because I want to harp on one person in particular, but one of the members of our program who never logs into here, by the way, he constantly emails me, he hasn't anymore, about the fact that he thinks that our program is not set up correctly because he keeps getting stopped out of trades when they're apparently going to work his way. Now, I point out to him that the risk parameters are there for a reason. The reason is if you can't figure out or you can't discipline yourself is the better way of saying it. Not you can't figure out. You can figure it out. It's a matter of discipline and practice and application. When a person tells me that the only way they can make a good profit is by letting the market go strongly against them first, where they're actually down more than they're going to make, or they're down so much that it's a large proportion of the maximum risk they can take. In other words, if you know you can lose no more than $3,000 in the entire program, during your challenge period, I should say, not the entire program, but during your challenge period, why would you want to risk that much in a single day? Why? Or a single trade? What would be the purpose of that? What would make that trade so good that it'd be worth risking the entire challenge for that one single trade or that one single day? Why? But everyone who does it, they always come up with an excuse. It's like, well, I knew the market was going to do this. I knew the market was going to do that. Right? So when you let me I'll get onto that later, Aaron. Let me get onto that later. So this is more important what I'm talking about now. So when you look at risk, right? You have to budget your risk. Now, those of you who've been here for a while, you've heard me say that before. You know what I mean. So for those of you who are newer, pay close attention to what I'm saying. Just forget about all the other stuff right now, watch list, etc. Okay? Because we need to focus on what's important. What's important is learning to cut your losses. Okay? Which means that it doesn't matter what strategy you use or what's the best way to approach it. None of that's going to count if you can't cut losses. Nothing counts until you can cut losses effectively and do it consistently. How do you do it? Honestly, you just have to do it, which is the harder part for most people, to actually accept the loss, not to fight it, not to say it's going to come back, not to say, well, I'll give it some more time, not to say I really believe it's going to work out. Forget all that. Just the moment the trade crosses the line that it's not supposed to cross, you stop yourself out immediately. And you don't ask questions about, well, what if it comes back? Well, what if it does? So what? Or what if I got out too early? Oh, maybe you did. So what? You don't know the future. No trader ever does, and that's not our job. Our job's not to know the future. Our job is to know how far is most likely too far. That's it. How far something has to go against us. The only way we figure that out is looking at our stats. So you have to generate stats first, which means you have to try. Now, let's just go over this next part here. So, in this particular setup, when I look at the middle ground of trades, which are the trades that are smaller in the middle, right? This trade was cut off at $67. So that means that the market couldn't have gone more than that far against the trade in dollars before it was cut off. This trade was cut off at $109. So the market couldn't have gone more than that far before it was cut off. Most likely, none of the gains, none of them at all, required a loss, a drawdown that was greater than this number right there. Now you can test that and find out if that's true. I always test it anyway, just in case, because you never know. Maybe there was some odd, bizarre thing that happened in the trade that, or this trade strategy, this trade signal that generated that result, right? Maybe it did go $300 negative first and then suddenly went $1,200 in favor, but most likely it did not. Most likely it would have cut itself off somewhere around here if we made it cut itself off. In other words, most likely it never got this far down, right? And then went positive. Most likely it got this far down and kept going negative. So the strategy that I was testing here is pretty much, I'm guessing, it was some random strategy off of Thinkorswim. In other words, I did some random technical strategy like a MACD strategy or a moving average strategy or something like that. And I plotted the results. So the way you do that, how many of you have Thinkorswim, by the way? The platform Thinkorswim. Sorry. I need to get a different chart. How many of you have that platform? Most of you probably do, right? If you don't have it, it's easy to do. Just take $200 out of your pocket, your bank account, open an account with them. You don't even have to do $200. You could do $50, but just get the software because it's good for learning, okay? Very good learning tool. So let me show you this. Okay, so here's Thinkorswim, right? I've got Zim on the screen. Why? Doesn't matter. Let's change it to a more familiar stock, Apple. Okay, here's Apple. Okay, now if I go here, I go to strategies. I'm just going to type in MACD. There it is, MACD strategy. I hit apply. This is showing me the results of the MACD strategy. Again, the process was I go here, go to strategies, I typed in MACD, I see this strategy there, I double click it, and it adds it there, and I hit apply, and there it is. Now what this is showing me are the signals that were generated over the last 10 years for Apple on a daily basis using this strategy. Now, let me just point this out right now. It doesn't matter what the strategy is. Let me repeat that. It really doesn't matter. As long as it enters and exits on a regular basis, that's all that counts. Now, what am I trying to do here? If I'm not thinking about this the right way, I'm going to look at this strategy and just look at the top and say, hey, right up here it says it made some money. FPL is the floating P&L. And if you look up at the top, it says that this strategy on a 100 share per trade basis over the last 10 years would have made $13,200 and something dollars. Okay, that's what it's saying. Is that good or bad? Well, I would say it's not so good, and I can tell you why. Because if you bought 100 shares at the beginning of this chart, right now you'd be up about $140 a share. So is this really that impressive? No. You're making about the same amount of money buying and holding the stock as you would, well, actually, buying and holding the stock than what you would trading it. So there's no edge here. There's no statistical advantage or anything like that to this strategy. It's just generating a result that's comparable to what you would have gotten anyway. Okay. Now, just for argument's sake, just in case I did the math wrong in my head, if we gain $140 a share times 100, that is $14,000, right? This says we're up 13,000 something. So essentially, for all of our efforts, we lost $800 in profits that we would have had if we just bought and held the stock and never did anything. So in that sense, this is not an effective strategy because even though it's profitable, it's not generating any more profit that I would have gotten anyway. Does that make sense to everyone? Just to be clear? Is everyone clear on that? Anyone not clear about that, let me know for sure. Okay, good. You're all clear. All right. So when you measure a strategy, that's what you should be thinking about first. Is it doing me any better than I would if I just bought the darn thing and held it, right? If it's not, then there's no point of doing that strategy. But let's analyze the strategy. How do you do that? To analyze the strategy, all I got to do is right click on the strategy itself where you see this text, right click here, and I say show report. Once I click show report, this report is showing me all of the results for every transaction that was generated by this strategy starting from the first, which was generated on 4/29/2013. Of course, this is a back test, so it didn't actually happen in 2013. Just doing a historical test. Notice that it's 100 shares buy, and then this strategy is a strategy that's always in the market, meaning that when it sells, it reverses from a long position to a short. So you go from a 100 share long position to a 100 share short position. Okay. So this strategy is always active in the market. It never is out. Whenever it gets a signal to buy, it flips over from selling short to buying long, and then vice versa when it goes the other way. This is not a good strategy because any strategy that has you always in the market, unless it's buy and hold, any trading strategy that has you always in a trade can't be a good one because how's it possible that every moment there's a good reason to be in the trade? That's not possible. So therefore, a trading strategy that's more selective is what you want. But if I take these results and I analyze them, I could still figure out how to make this strategy profitable, or at least modestly profitable. It's not going to make a lot of money, but I can make it slightly profitable. How? Simple. Cut off the biggest losses. Figure out how big are the biggest losses. Find out a cutoff point that's not required for the stock, for me to go down to, for me to make my bigger profits. In other words, as long as I know where the cutoff point is for my better profits, I will still end up making some money because my smaller losses, they never required me to hit that, those bigger loss levels. I get stopped out prior to hitting, let's say $235 in our other example. So you can use Thinkorswim to do that. You could play around with it if you watch some of their educational videos on the on their software. They can explain how to do this stuff, right? But I'm just giving you a quick introduction to this idea for those of you who've never seen it before. Okay. I also have a video, by the way, which I'll link to here. It's called Introduction to Strategy Analysis. Hold on. This also covers this topic in detail. Okay, I actually go through examples. Now that I've figured out what my cutoff point is, basically I can reorganize these losses here. But here's the trick, and this is the one part I want to mention. I can't possibly cut all these losses off altogether, right? These losses here, if I could eliminate them altogether, I would definitely go positive. But here's the catch. The catch is these losses that are larger, I can't just eliminate them. I can't snap my fingers and they go away, because in order for me to get to negative $1,100, I had to first get to negative 235. So in short, if I actually use this as my cutoff, I'm basically saying that all of these losses that are bigger than $235 get flattened at $235, which is going to make a big difference. Let me show you how big of a difference it is. So let's say 235, right? Let's say this one's 235. We're just going to go down the list. 235 actually should be negative, but anyway, hold on, let me do this again. So these are all $235 losses. Let's make them dollars. Okay. Now let's look at the sum difference. This right here, which is the part that we're cutting off as far as losses, That's worth a grand total of $8,225 in losses. This, the previous way it was laid out, is 13,595. So that's a difference of about $5,000 difference, right? So basically, I'm cutting off $5,000 worth of losses from my total that I don't have to realize because the market doesn't have to go but so far against me. And if I keep refining this even more and more, what I'll probably realize is that I can actually cut the losses even sooner than that. In other words, we might be able to cut them at $168, not $235. And if that's the case, then the losses will go down dramatically. In other words, all we're doing right now is trying to figure out, when we do this experiment, where would be the appropriate cutoff point where my results that are positive, as many of them as I can get, I just need to figure out how far the market really needs to go against me to get those positive results. And I can start off by cutting off my worst results because I would know right away that most likely there was no need for my top 20 percentile of losses. I should have been able to cut myself off before I let these get any deeper than what they were. So that extra $5,000 or so, when added to this P&L, now puts us at negative 1,000. Doesn't put us in a positive, but greatly reduces our loss. And then from there, I have to look around and figure out what else I can change. The easiest thing to look for is to see, can I cut the losses off sooner? Like maybe I can cut them off at negative $100. Maybe I look at all my results and see how many trades actually went $100 against me first before they went in my favor. And if I find out that very few did go negative $100 against me, then that's a good thing to know, because that means that I can eliminate, if I find out very few went up negative 100 against me before they went in my favor, if that's the case, then I can cut loose a lot more losses. Yes, maybe I'll cut off some gains too, but overall it should end up being a profitable venture, because let's just look at the math. Let's say I can cut off at $150, right? Let's use this as an example. If I can cut off at $150, watch this. Let's see how much the change is now. So now I've got a sum total of negative $10,500 in losses there, right? But if I add these up, I've got negative 20,000. So now I'm shaving off another 10 grand in losses off of what I would have realized, which means I can basically add that to this, because I actually shaved off that much in losses. Now I'm definitely in a profit. So believe it or not, this is the way that a typical trader at a professional level would analyze a strategy. They would look at the actual parameters of what the strategy does and use that as their means to figure out how to optimize the strategy. In other words, they need to know where to cut loose. Now, most of us are focusing all of our attention on those extra big winners that we see, and we're all focused on, like, wow, how can I get more of those? How can I hate, in other words, we're so obsessed about getting the big gain that we're missing the actual meat and potatoes of this, which is cutting losses. You cut losses, you will make more money. It's just the way it works. So when I was working at Great Point Capital, I do have to run here. I have a call I have to make. But when I was working at Great Point Capital, one of the important things that they taught me was that you first have to look at cutting your losses. So just like I'm doing with you guys now, they walked me through my trading stats, and they showed me all of my losses, and they basically drew a line on the chart and said, hey, if you were to cut your losses, and they literally drew a line on the chart and they showed me where to cut my losses. It was a plot that looked something like this. This is exactly the plot they gave me. And they drew a line like this, like right here, and they said, okay, If you cut your losses right at this point, you're going to truncate them enough that you'll make a profit. Once I saw that, that was it. Once I realized that that's really what it takes, that's the first thing I did. I forgot about trying to find out a different set of indicators or different chart setups or different chart settings. I just skipped that. I said, you know what? This is it. So that's what I did. I just kept doing the same basic strategy I was using already, but I started cutting off losses. They also showed me the stocks I was trading, which ones were generating the losses the most. I cut those off too. In other words, if you had stocks listed instead of trades, a lot of us would have Tesla at the bottom, and we would have some other stock at the top as far as our gains. And basically, just as surely as I can cut off individual trades at a particular loss point, I can also eliminate certain stocks from my repertoire if I know that they're not generating, I'm not doing very well trading them. So in short, focus on cutting the losses. Okay, more than anything else, focus on cutting losses. And if you need practice, you can actually practice on Thinkorswim. Now the problem with Thinkorswim though is that unless you know how to code, I do know how to code in Thinkorswim, but if you don't, you won't be able to modify a strategy to test the hypothesis of what to do. But here's another way you can do it. Remember that this lists all of the actual entries and exits. All right, so when you see this report, since it's telling you the date, the time, and the price of an entry, these are all on the close, right? The close of a day. So in other words, this trade happened at the close of business on April 29th, 2013, this back trade, and it happened at this price. So now all I have to do is look back and say, okay, if that's the price the trade happened at, and that's the time it happened at, I can map out what happened after that time. In other words, if 1502 is the entry point, how far did the stock go down and how far did it go up before it generated this result right here? If I find out that this went $35 against us first before it went $35 in our favor, okay, that's something I need to know. I can note that down. So I note the P&L low for each trade, the profit and loss low, and the profit and loss high. Now, a lot of us honestly don't want to do this type of work, and I get it. A lot of us want to just have it all put in front of us, but I'm just going to tell you this. If you're in this program and you're trying to get funded, you're expected to be a professional, not an amateur trader. You're training to be a professional. Your actual legal title will be a professional trader. If you can't do this work, if you're not willing to do this work, then you're not what we're looking for anyway. You're not going to pass the qualifications anyway. And if you happen to get lucky and do, within a short amount of time, you're going to crap out. Because if you don't do this work, you're not going to even know what you're doing. So my advice to everyone, if you're newer at this, keep trading, follow a basic strategy. Now not Edwin, Aaron, you asked a question earlier that I'll answer really quick. You asked the question, I noticed you had a watch list of 6 stocks this morning as a starter. Would you recommend focusing on one stock at a time, and how much would we start with in a trade? Okay. Personally, I would say since you're newer at this, you probably want to wait a little longer before you get into any of the stocks that I mentioned pre-market. Those are the most volatile, they're the most dangerous, and they're the ones that you have to be most clearly experienced. You have to have some understanding of what you're doing to trade those. They can be very big winners, and they can also wipe you out. So, in short, I would not recommend that if you're a beginner, I would not recommend you focus on those stocks. But as the day progresses, if any of them gets into a steady trend, then focus on them. But until that time, honestly, you should ignore them. You should just wait for any stock to get into a good trend. I'll be pointing out different stocks as we go. Those are the ones you want to focus on if you're a beginner. If you've got some experience, even if you're not the greatest trader, You might be able to make some money off of those early morning stocks, but again, those are much more volatile. They're less predictable, and a lot of them fail anyway. So you don't want to focus too much attention on them. What you do with those stocks is you wait a few minutes, you watch the open to see if any of them starts a strong trend. They start to get consistent and going up. If that happens, then you're going to take a small risk, meaning that you're not going to risk enough money in the trade where if it wipes against you, you're not going to lose any significant amount of money. By significant, I mean you should be keeping the losses very small. Now, if you're experienced and you know you can make $400, $500 a day in trading, then you can risk more. But if you're inexperienced, you don't actually know how much money you can really risk until your stats are generated. So you have to keep your risk small. So in short, it's going to be difficult for a new trader to trade those stocks because you have to understand something about volatility. You have to be able to calculate very quickly in your head how much risk you have to take to be in that trade. So if you're new, I would suggest just ignore those altogether. Focus your attention on the bigger name stocks. Okay? Apple, Microsoft, stuff like that. You're going to have better success. If you aren't newer, but you're not very disciplined in how you trade, you also want to avoid those. Those stocks do best for people who have a good sense of how to manage a trade already. So, Aaron, I would suggest get your chops, learn your chops on the standard stocks, the Apples, the Microsofts, the Amazons, the major stocks that are moving, or less known stocks that are on really, really good trends. If the stock's on a great trend, go for it, because a great trend on an obscure stock is just as good as a great trend on a stock that's well known. A trend is a trend. So if it's trending well, go for it. But a lot of these stocks that I'm identifying pre-market, they're going to be quite difficult for a lot of people to trade at the open, which is why I suggest you trade small first if you're going to do them until you actually can see some results, like the stock's actually going your way. Then you can start to leverage up and trade more. Okay, so that's a long-winded explanation of that. All right, so folks, I got to run, but I just wanted to give you guys a heads up. So if you do some homework, here's what I'll do. I'll export this file as a CSV. Yeah, let's put that in documents. All right, I'm gonna put a link to this here. So give me 1 second, and all you guys have to do is I'll put this as sample. Why is this not typing? Hold on for a second. Oh, file. Where'd that go? Documents. There it is. Okay. I'll call this. This is a sample strategy report from TOS. Okay. Now let me ask you guys this. For those of you who try this, you download this file, right? You open it in Excel, and what you're trying to do is recreate a listing of results. We're going to rank them from best result to worst result. Okay, you're just going to tell Excel to resort the results. You may have to separate them off, copy and paste them into a new sheet or something like that, but you basically reorganize them to where they're sorted from best result to worst result. And once you do that, you want to count how many wins you have and how many losses you have. For the losses, you're going to count how many you have and then look for the top 20 percentile. So in ranking, that whatever the top 20% is, those are the stocks, the results are you want to highlight, like I did here. And once you highlight them, that's your first cutoff point that you know you're going to use. So you're going to use that as a blanket place where you're going to say, wherever that top 20 percentile starts, whatever negative loss value there is, in this case 235, that's going to be your starting point. You're going to say, I'm not going to lose more than 235. So I'm going to cut off all losses that are 235 or greater. And then you're going to look at the individual results of every other trade that's still remaining and make sure that they never went more than $235 against you. As you go through the list and note how far they went negative before they went positive and you took a profit, you're going to get some stats. You're going to finally realize that you're going to realize how far the trades had to go against first before they went in your favor, and you're trying to cut the trades off as quickly as possible. So as you dial it in, you'll eventually figure out the cutoff point. Now, what's interesting is this. When we look at our prop report stats, when they show us our win to loss ratio, and they show us they show the average win versus the average loss, that's basically a shorthand way of doing this. In other words, as long as you trade and you always cut your losses much earlier than the average gain you're going to get, that's what's going to get you to profitability much faster. This is just a longer way of doing it, but it's a more detailed and efficient way of doing it where you really get the hard numbers. You'll actually know exactly how far a stock can go against you before you need to cut loose based on whatever strategy you're using. And that will make you more disciplined to not let the stock go too far against you, because you're going to know if you do, you're pretty much adding to your loss quota. Your stack of losses is going to keep getting bigger because you're letting the market dig deeper and deeper against you, rather than just cutting it short before it has the chance to. So focus on that. I would do that as homework. And for those of you who do, once you learn how to do that, then you can take your own results and prop reports. All of your trades have a result. They tell you what won, what lost. You can download those, upload them into Excel, sort them out, and figure out exactly where your cutoff point should be. Just like you can do this for this generic strategy on Thinkorswim. So in summary, if you can make this improve dramatically, and this is the most basic, unintelligent, lackluster strategy possible, if you can make that improve, imagine what you can do when you're actually using your mind, which you all are, and using better information than what the MACD is able to give you. Okay? So I'll leave it at that. Everyone have a great afternoon. I'll see you folks tomorrow morning, 7:35 Central, 8:35 Eastern, for the pre-market pulse, and then we'll go from there. All right? And I'll upload this recording as soon as I can. I may have to wait until I get to my home office to do it, but I'll upload this as soon as possible. Okay? Thanks, folks.